Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me again Robert McHugh. Dr. McHugh is the president and CEO of Mainline Investors. Was founded in 2003. Provides a technical market forecast, largely Elliott Wave, but he uses a whole lot of other tools as well. A very interesting product that he puts out. We just talked to Michael Oliver, who has his own proprietary system, and between the two of them, I would say that my two favorite technical analysts, and Dr. McHugh also comments from time to time on fundamental issues, but he's largely approaches the market, at markets, I should say, many different markets from a technical point of view. And he provides an awful lot of information every day. Now, you can subscribe to his service and you'll get an executive summary that you can start with that. So if you don't have time to really dig into all the meat that he provides, you at least have a good idea of what the overview is. And so that's what I do. Go to technicalindicatorindex.com, technicalindicatorindex.com. Lots of very important charts and information there, and I think really helpful in terms of gauging where we're at in the market at any given time. Dr. McHugh has also written a book that I think is a must-read if you take a long-term view, actually perhaps a short-term view now, because this book was published a few years ago, I don't know, a couple of years back, but 2013, I should say, not 1913, that was the Federal Reserve, and those are the guys that have gotten us into all the trouble we're into, but 2013, but now 2015, and it looks for the world as though much of what Dr. McHugh talked about in the coming economic ice age is in fact coming to pass. So thank you very much for joining me today, Robert. It's always good to talk to you.
Same here, Jay. It's always a pleasure.
Always a pleasure to talk to you, even though a lot of the things you have to tell us are not necessarily things that we want to hear. I think of you in many ways like some of the Old Testament prophets that said things that had people throwing stones and rocks at them, but I think that's better to face the truth head on than to try to duck away from it. In your July 27th missive, you said, and I quote, "The top is in for the rally from 2009 and for the rally from 1987 and for the rally from the 1700s. A grand supercycle degree bear market is starting with the first leg wave 1 down of 3 down. You have to really follow the Elliott waves to follow that argument. But help us understand why if I understand this now, you're really calling for a major decline. First of all, most people would say, okay, I could see maybe the top from 2009, the correction from 2009. Maybe we get a 10% correction, right? And I think that, a lot of mainstream people would be okay with that. They don't like it, but they say, okay, well, that's normal. When you talk about this correction from 2009, where do you think the market's going to go? Let's say that the market was correcting only to the excesses from 2009. If that were all that were in store for us, where would we go? Where would we be headed in the near term?
Well, if we were correcting the 2009 rally, correction implies you're only taking down part of what we gained. So, people would probably put a bottom for a decline in the neighborhood of 14,000 on the Dow to 12,000 on the Dow. I happen to think it's going to be a lot lower than that, but that could be an initial leg to what I see coming. If you're just correcting from 2009, but this thing's correcting a lot more than that.
All right, so the same question, if we go to the 1987-2009 excesses, how far down would that take us? Maybe the second leg down?
Well, that might take us to the 2008 bottom, which would take us around 6,000, 6,500. But that again is just taking us to where we were before. And I think that the coming decline is going to drop us further than that. I mean, the 1987 levels were at 2,500 before that crash, and they went down to like 16, 1,500. So, I see this thing going all the way down there, dropping from 18,000 all the way down to 1,500 or even less at some point. Not overnight, not next month, but over the next 5 to 7 years, yes, I do.
1,500. So now we're talking
Yeah.
about the excesses. That would take us back to the excesses. You're talking about the excesses from 1700s. I mean, that's unfathomable to most people, Robert.
Yeah, we're about to see something that's unfathomable. We're about to see something that's going to change the world as we know it. There's a pattern here, and I mentioned in the book that you mentioned, showed 8 instances of this pattern appearing in the last century. Each time was followed by some sort of stock market crash and economic collapse. But the problem with this one that we're watching now is it's exponentially larger than any of the others. This megaphone top pattern, I dubbed it the Jaws of Death, started in 1987. This is over 2 decades long. Those other patterns were a couple of years to 6 months long. This is 25 to 30 years in development, and it's massive. And it implies that it's correcting a very, very long-term rally, and I've said it from the 1700s even. And it implies a bear market of super cycle degrees, grand super cycle degree. The Great Depression of the 30s was just a super cycle degree. This is a grand super cycle degree for market economic collapse that's about to come. And this pattern has a very high reliability, and it gives you good downside targets. And those targets are getting us down below 1,500 on the Dow.
By the end of it.
By the end of it, and it could be a 7-year process, 5-year process before you see the bottom. But yes. Mm-hmm.
I think that I think that's just, it is hard to fathom, and most people can't get their head around that. I have trouble doing it. I think everybody has trouble doing it. We've talked to Robert Prechter on this show. I think he's there with you on that pretty much, although I haven't spoken to him recently. Ian Gordon, who's been on this show in the past, has talked about $1,000 Dow and a $4,000 gold price, and I want to get to your views on gold. But before we do that, when you talk about grand super cycle, you're talking about, that's an Elliott wave concept, isn't it? These cycles.
Yes, the waves are labeled in smaller degrees, and the next higher degree, and the next larger degree, overlapping as a large umbrella the smaller moves underneath them. And this is a gigantic bullish market that we've had since the 1700s, as measured by the United States stock market, and prior to that, the English markets over there where they were tracking prices and so on. This has essentially been a 300, 400-year or 400-year rally in our global economy. That's about to change according to the Elliott wave pattern and other things that I track. There's going to be some major changes coming.
You could argue, I guess, as a lot of us Austrian thinkers do, that the major bulk of that move from 1700 has come more recently, since we went off the gold standard, since we started printing money, almost infinite amounts of money. You think there's some validity to that argument?
Yes, there's no question that the prices that we look at from where we're going to be falling are inflated because of the the ridiculous printing of money and the hyperinflation of our currency. So it's like a balloon that's been blown up too far, too fast, and it's going to pop.
You just mentioned that you look at other things besides the Elliott wave. I guess, I think of you as primarily an Elliott wave guy, but when I look at all of the things that you put out there every day, you look at an awful lot of other indicators, other tools too. Could you tell our listeners what some of the other technical tools are that you use?
Yeah, I just mentioned one, the megaphone Jaws of Death pattern. It's a pattern. It's a picture. The stock market and other markets, they have a language, and they tell us where they're headed next because they are the accumulation of all knowledge all over the world from everybody. And it's a measure of the psychology, the group psychology of everyone at any particular point in time, and it can forecast when psychological mood is about to change. And it can actually give us, these patterns can give us an idea of reversals and how deep the ensuing reversal will be, how long it will take for the reversals. So I really like patterns an awful lot in addition to the Elliott wave, which is more of a wave counting type science. And then I love cycles. There are a lot of interesting cycles I noticed a 7-year cycle going back to the beginning of the last century, and then as I was doing more research, I realized that there's actually that ties in with the Jewish calendar and the Shemitah years, and that's biblical-based cycles, and then you have other different kinds of cycles that I know a lot of other guys spend a little more time on than I do, but those are some cycles that I keep an eye on. Seasonal things, typical periods of time of the year when you expect to see rises and falls in certain markets that you're following. And then the other thing I like to look at are divergences between prices and indicators that I watch. When you see the indicators are going in one direction and prices are going in the other, there's a good chance that the prices are about to change direction. That's a good early warning sign of a probably a more smaller move. You're looking at the smaller gyrations with those type of divergences than the major moves that we were talking about with the megaphone top pattern, that kind of thing.
I would just mention to the listeners that in the coming Economic Ice Age, Robert's book, in Chapter 2, I believe it was Chapter 1, actually, it shows a number of times that we've had since going back, I guess, since the stock market crash of the 30s. This megaphone formation has preceded major crashes, hasn't it? In almost every case since the 1930s. Is that right?
Yeah, I counted 8 of them since the beginning of the 1900s, and I looked for more, but those are the ones that really caught my eye, and I couldn't find really any others, and they were preceding the 1929 30s depression and the 29 crash. It was there before the 87 crash. It was there before, well, going back even more, it was there before the problem in the 60s and 70s with our economy and the oil embargo and what that stock market did then. It was there before 9/11. It was there before the 2008 crash that we just saw 7 years ago. And it's here again now. And the one that we have now encompasses megaphones that were there in 2008 and 2001. Those were subcomponents of this larger one, which is really interesting. They call that a fractal, and they were fractals of this larger degree pattern. That's what makes this thing so ominous. It's just huge.
Yeah, I kind of picture, seeing a little fish getting eaten by a little, somewhat bigger fish being eaten by a major, gigantic fish. So you have megaphones within megaphones, is what you're talking about. Yeah,
that's a good example you just gave. That's a good way to look at it.
So most of the time, at least, I look at your different indicators. Some are suggesting bullish, some are suggesting bearish. But what was it on July 27th that caused you to say, basically to say, this is it, we've seen the top? What was it that really caused you to make that call?
The large-scale megaphone top, the jaws of death from 1987, looked like the prices had just about reached the top. So we were looking for something that would be more precise in identifying is the top in, and that meant we needed to focus on a smaller pattern. And we looked at, we've been tracking a rising bearish wedge in the Dow Industrials since October of 2014, and prices had been governed, the rallies and the declines, by the upper or lower boundary of these two converging trend lines, which make up a rising bearish wedge. And what you look for is when prices break down below the bottom boundary, then you can have confidence that the rising wedge is in. And since that was the last significant pattern and the end of our Elliott wave counts for the larger megaphone pattern, this was the final pattern we've been watching for the green light that, okay, the grand supercycle bear market looks to be starting. And in fact, that's the day the prices broke below the bottom boundary of that rising wedge from October 2014. And so we have come out with a conclusion that the odds are very high that the grand supercycle bear market is now officially underway.
Another thing you talk about, the Hindenburg omen, and you talk about two of them being on the clock right now. Can you explain to our listeners what the significance of a Hindenburg omen is, and can you talk a bit about the rationale behind it, why it might be of significance?
Yeah, a Hindenburg omen is a set of market conditions that, when they occur, you have to be on the alert because it identifies a situation where the market is stock market is fragile. It primarily focuses on new highs and new lows on the NYSE every day. And normally, a normal, healthy bull market or rallying market, rising market, or any kind of healthy market, could be falling, but it's healthy, is when you have a predominance of either new highs or a predominance of new lows, but not both at the same time. If you have a lot of new highs, that's an indication that the market's in good shape, it's headed higher. If you have a lot of new lows, it's an indication that the market's becoming oversold and it's about to reverse and you're going to have another rally. But when you have both new highs and new lows above 2.2% of New York Stock Exchange issues traded on that day, and the 10-week, the 50-day moving average is higher than it was 10 weeks earlier, and the McClellan oscillator is negative, which is an advanced decline line analysis. When you have these conditions all together, that is an omen, a Hindenburg observation. When you get two observations in a 30-day period, that is an official Hindenburg omen. This omen has been present before every stock market crash over the last 35 years, and I define a crash as a decline of 15%. Except one small one a couple of years ago in the middle of the summer. We had a mini crash. But it's there every time. So the point is, if you don't have a Hindenburg omen on the clock, you're in pretty good shape. You don't have to fear a crash. But it was there before the 9/11. It was there before the 1987 crash. It was there before the 2008 crash. And so it's like a necessary precondition for a crash. So if you're expecting a crash in the fall, but you don't have a Hindenburg omen on the clock, then you're pretty safe, and there's a conflict of indicators, and there's less certainty about the coming event. But this is like a confirming of other work that we have that says watch out for prices this fall, because it's now on the clock. In fact, we have two of them. They have a 4-month shelf life, and we have two of them we just got in the last month, two separate HOs. So now we have that necessary precondition in place. And we can go back to focusing on the other events, the other indicators, the other patterns, and so on. Keep an eye on when the most damage could happen this autumn.
If we it sort of looks to me like it's sort of a bipolar market. It's a market that is without conviction in either direction, tugging and pulling in both directions. Michael Oliver was talking a little while ago about how when you have these major changes, like we've seen gold sort of meandering around the bottom here for a protracted period of time, that the S&P and the Dow hasn't really gone anywhere significant on the upside for quite a while. Is this sort of typical then of these major turns? Is that you get this sort of tugging and pulling and bipolar nature of a market? People can't make up their minds.
That's true. That's true, Jay. That's exactly right.
Do you have a prediction as to where the Dow and the S&P might finish this year? You have some targets in mind?
I don't, because my thinking is that we're going to see a stair-step decline between now and the end of the year, and I think that it'll start out with relatively mild declines followed by bounces. But at some point this autumn, I'm looking for a significant decline. Maybe a crash, probably a crash, and then there will be a bounce. So by the time you get to December 31st, if we're in one of those bounce phases, that gives you a completely different price target than if we were at the lows, which could appear, the lows for the year could happen in the middle of October rather than in December.
Sure.
So it's hard to give a number for year end, but I do think we're going to see a decline, I think at least 15%. Possibly much greater over the next 6 months at some point. And I kind of feel that the September-October period, as it usually is the most fragile period of time, the most likely possibility of a time when things could fall apart.
Do you have any idea, any theory as to why that's true?
It's interesting. I try to look for rational reasons, and I couldn't find anything. The only thing I've ever found, which is interesting, is that it's the biblical period of the Shemitah year.
Mm-hmm.
Every 7 years, it's a biblical in the Jewish calendar Shemitah year, and that happens to be in the autumn in the Jewish fall feasts, and so. That's the only thing I could find, and that doesn't really, it's not a secular answer, but I don't see any other reason to come up with an answer why it's always in the autumn.
All right, we got only about 5 minutes left. I want to ask you gold and precious metals, because you've been suggesting that gold has been in a bottoming pattern, and you've been talking about a bullish declining wedge pattern. Talk to us about that. Why is that a bullish pattern, and why do you think things are going to be better for gold bulls in the near term?
Yeah, gold is finishing a declining bullish wedge, which is a convergence of tops and bottoms, and it just looks like a wedge you'd stick under your door to leave a door open. And what it means is that selling is being met by increasing buying as time progresses. The lower the price tries to go, the resistance is there, the support is there, and the buying is increasing. So, and that pattern looks complete, or very close to it. I think gold's going to turn around soon, and I think mining stocks will do the same as will silver. They're all kind of in the same type of pattern.
You talked about the commitment of traders recently as a sign of bullishness for you. Explain that to our listeners, if you would, please.
Yeah, the commitment of traders is data that tracks futures and options positions in gold. And it tracks commercials, which are basically your insiders, the companies that own and produce gold. And then you have the speculators, which could be hedge funds and that kind of thing. And the speculators are usually always wrong at turns. And they're very heavy long futures right now. I mean, very light long futures. They're very heavy short futures. And whenever you've seen that over the past couple decades, it usually means that gold's about to bottom and turn up. So we have commercials that are long, we have speculators that are short. And what's going to happen is once the market turns, once gold selling exhausts and it starts turning up, you're going to see a gale wind force of short covering by speculators. The very people that were most bearish about gold will suddenly be the ones buying it, and that'll produce a buying wind behind gold and get it rolling. Then I think the stock market crash or trouble, plunge, whatever you want to call it, coming this fall, gold safe haven appeal will kick in, and that'll add more buying for gold. And then as the economy starts falling apart, which should be evident by the end of this year, the Fed will probably reverse course and have to start printing money again, because that's their solution to everything.
Sure.
And that will mean that the currency is going to be devalued, which is good for gold. Gold will then rise on that as well.
Well, it certainly makes sense. You've been talking about $1,400 gold. Is that still sort of what you're looking at as a possibility before the end of the year?
I think that's a real possibility. As long as we get the plunge I'm expecting in the stock market, yes, I could see that easily. And
silver outperform gold on the upside. It generally does. It seems when the sector turns bullish. That is when the precious metals turn bullish.
Yeah, I don't know. It depends on what kind of geopolitical crises we see worldwide that come along with this plunge. Is there going to be an Iran-Israel war, or is there going to be some kind of war in the Middle East, or so on? Russia gets involved, or whatever. How much fear is out there? That could push gold higher than silver.
Well, Robert, you're talking about some things that are cataclysmic. I think you've used the term cataclysmic nation-changing event, being the stock market decline. It's not hard for me to fathom what happens to society. Can you paint a picture in about a minute? What do you think might occur here, and how should people be planning as this thing unfolds?
It's really hard to tell people how to plan. I think they have to evaluate the risks and look at their own position and try to figure that out. But I see political change. I see nation-changing politics. Just the United States in Europe? Do they unite? Do they unite with the same currency and drop the euro and the dollar? Could there be an invasion of the Middle East by Russia that seems to be a little interested in flexing their military muscles right now? How much conflict will there be between Israel and Iran? I just think a lot of these kind of geopolitical, because wars, I've shown in my book, happen after each one of these patterns, these jaws of death patterns. War happens each time. So I expect war, and I expect that's going to change the politics and then the finances and economies of the entire global picture here.
Oh, okay, Robert, we're going to have to leave it go at that because we are out of time, regrettably. But, folks, check out Robert's website again, technicalindicatorindex.com, technicalindicatorindex.com. Very reasonable subscription price. Go there, subscribe to this man's work. It is excellent. It is tremendous amounts of it and good, easy to comprehend. So please go there. Do yourself and your family a favor. Thank you very much, Robert, for being with me again, and I look forward to doing it again sometime in the near future.
Thank you,
well, folks.